Hello, my name is Raitis and welcome back to another evening commentary. You're here at Farewell Total Return Investing, and in today's video, we will be going over the price action from the 11th of February 2025. So let's take a deep dive. Today is the day before the FOM's CPI news release tomorrow. We have President Trump speaking as a tentative news event, so it has no timestamp. And we will be going over dollar and all the other major asset classes. So dollar, bonds, equities, and also gold. So as always, let's start off with the XY, and excuse the outfit. I just came back from my training. So yeah, you have to live with that, and it's already late in the day. So you can see we have the daily fair value gap, and market failed to close above the daily fair value gap, and today we opened trade a little bit higher above previous day's high and smacked lower. So this becomes real probability, and now I'm really neutral and I do not know what the market wants to do, because we have we have CPI tomorrow, and this will hopefully bring us some clear narrative inside the marketplace, what the market wants to do, either if it wants to run higher or lower. It has to do something, because otherwise right now we're stuck in this consolidation. I talked about this on the weekly outlook. We are in trapped order flow conditions, which is low probability. And yes, so we took a trade today on NQ, and we will go into that later. And we also passed two Apex 50K funded accounts, not funded accounts, evaluation accounts. So yeah, we're gonna go into that trade later, and because it's a really interesting trade with some key insights. I have journaled from last week actually, or 2 weeks prior. I added a new, let's say, filter to my trading model, and this filter I did apply today. But again, DXY, I really do not know. We may sell off from the daily fair value gap, but right now it's really 50-50, and I do not know what the market wants to do. That's why I will avoid trading currencies and everything else before CPI. T-note futures actually, and then we're gonna go into that topic in a second, because you can see T-note futures are bearish, dollar is bearish. So we have decoupled markets, another low probability filter. So one of these assets is being manipulated, and I think dollar is being manipulated, and we could see a run higher again on dollar. This is what I'm thinking, but again, this is a really low probability claim. But our analysis on 10-year T-note futures is really playing out. I mean, you can see we redelivered, we had an immediate rebalance of this daily inversion fair value gap, and markets sold off. And hopefully we close below the 50% of this bearish order block on 10-year T-note futures. Let's look at 5 years. Yes, wonderful. Already below the order block, and 2 years should be already far below the daily bullish order block. So if we can close above below the 50% of this down close candle, then I want to see continuation lower. Again, we have this retail pattern where we have this left shoulder, head, right shoulder, neckline, market breaks above, retail traders are trapped long, and now with open float liquidity residing below this low and this low, and then market reverses and takes out all the traders who got in long. So you can go and look at the weekly outlook. I already talked about this on Monday when I uploaded the video, so no hindsight here. I was talking about that we should inverse the fair value gap and sell off. Yeah, so again, we're also trading from the weekly volume imbalance, but again, look at the weekly commentary. Also, we have the monthly redelivered imbalance. Look how Monday's candle traded up and potentially and hopefully created the high of the week at this key hard time frame level. Now we're selling off. So this is confluence. Again, for our Favel, yep, it's now T-bonds are really looking good right now for bearishness. We have sell side right here. This is a high resistance liquidity run, of course. But let's see how we can trade through that, because market could defer liquidity into CPI. So I think this liquidity pool should be gone for tomorrow with CPI, and dollar could trade higher, but we have decoupled markets because dollar we're seeing a down close candle, T-bonds we're seeing a down close candle, so something must be wrong. Euro up close candle, pound up close candle. Let's look at the CFDs. USD CAD bearish, okay, that's correct. AUD bullish, NZD USD bullish, USD CHF bullish, which makes no sense because DXY is bearish. Like, where's the logic? There is no logic because we have decoupled markets, and USD JPY is bullish. So this is yeah, really, really, really low probability market conditions, which we're trading in right now. And you can see exotic pairs are trending nicely at the moment because DXY is inside range. And yeah, so probably better off trading the crosses and exotic pairs than sticking to DXY, because we're inside trapped order flow and are hanging inside a range. Now I don't want to make this video too long, so let's get into the trade from ES from today. And sorry, NQ was the trade. Now, again, I'm gonna give you this protocol right here for free, which I implemented. So as you can see, at the start of the day, I really didn't see a lot of volatility in the market. Market was just trending lower again, and we traded down into the weekly order block. It was already around 9:15, 9:30 displaced higher, and then we saw displacement at 9:30 from this key weekly level. So we saw institutional sponsorship going up from here, and this is a massive displacement. So this is clear indication of higher time frame institutional sponsorship. ES also saw displacement higher than YM. YM really was inside a massive consolidation and looked really, really ugly. I mean, you can't call this really displacement. Of course, after post 10 a.m., we saw some rally, but that's already a question. Another question. What did I trade today? I traded a short scalp because I really had only, it was like 1 or 2% where of my challenge, which I had to make profits on. The challenge would have lasted until the 18th of February, so I thought, and I needed already 1 or 2 good trades, and then would have passed the challenge. So the trade was right here, 50%, because this is a busy. I do not want to see market trade back to that 50%. So stop loss right here, and then I scaled off at a 1 to 2 because again, I only needed 2% to pass the 2 challenges, and then my target was actually right here at the consequent encroachment of the daily volume imbalance, I assume. Yes, correct. Again, we have this H4 liquidity draw. So the relative equal highs also on ES. This is my H4 liquidity draw. And we can see that market started to rally, and then we got even a nice continuation play during lunch session. Market trades into H1 order block, trades higher. Nasdaq, same thing. YM, 1 hour fair value gap, institutional order flow entry drill, trades higher, and now we're distributing above this high. And also on ES right there. So what's the protocol? Market saw displacement during, actually I could add this to my protocol. Let's delineate the sessions, because I can even make an adjustment to my protocol. Now, okay, let's leave 12 a.m. So we have a London session. London session, just basically consolidation, takes out sell side, takes out buy side, or trades back into the range. Then New York session sees higher time frame displacement, and we saw, this is the key point here. Now, why do I have the XY? So we have S&P, we have NQ, we have YM on the right side chart. And you can see that on NQ, we have this low right here on YM. We make a higher low. We see a lower low on NQ, and we see a lower low on ES as well. So yes, relative strength is on the YM, but again, YM was massively inside a consolidation. Okay, now what's going on here? YM, from a structural perspective, we saw no key lower time frame displacement from a weekly or monthly level or daily level, while NQ saw some nice and aggressive displacement higher from that level. And because of this divergence going into London close, where we had the 10 a.m. news right here, Fed Chair Powell testifies, I didn't expect another stop run below this low, because we already saw distribution from key higher time frame level, traded below H1 sell side right here, below these relative equal lows. So I didn't really need to see another stop run below external range liquidity. That's why, because of this divergence inside the previous session, which was I was trading London close, so New York formed this divergence and saw displacement from a key higher time frame level. I didn't expect any run below this low. That's why we had this BISI. I didn't want to see market trade below 50% because it's a protocol for a BISI. So I just traded institutional order flow entry drill with the 15-minute time frame right here. Stop loss again below 50% of this BISI. And then I targeted a key higher time frame level for a nice risk to reward ratio. And then my other account even went up to 1-3 exactly, because and then luckily I passed the challenge, but the stop loss was already at break even once we were trading around this level, because the market could easily distribute at this key high time frame level and then sell off, which it did. It didn't trade above the high. So, and again, I talked already about this stuff on the weekly outlook. Please do not hold for external range liquidity runs. Don't have your high hopes of getting in a home run. Market could easily just trade to the rejection blocks, which it didn't do even right there, because we already saw yesterday, Monday, taking out the rejection block of this high right here. So yeah, I already talked about this again. ES also, we could see some upside on ES still, but yeah, we already talked about this. Be very conservative with your targets. Also, with a new week opening gap actually. Or, no, sorry, this is new day opening gap from today's price action. So right here, which would be also a nice target, and then market reverses. And yeah, so again, life lesson learned. If you traded longs, I hope you took profits. And yeah, that was the trade. So nice confirmation with divergence inside the prior session. Key higher time frame displacement from the weekly order block open and weekly breaker open, and then nice high institutional order flow entry drill, and with a nice risk to reward ratio to finish off the challenge. And with that said, I promise we will look at gold, 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 gold. Yo, you can see we're coming close to our first standard deviation projection. Markets saw a run higher initially and then sold off. We said the run higher was during Asian session. Now, again, this is where the confluence comes in. How is DXY bearish and how is gold bearish? Again, another confluence for low probability markets. And the reason why you also shouldn't swing for home runs on these trades, why you shouldn't hold above external range liquidity. Yeah, so we're in really low probability market conditions. We have disparity between asset classes, and then I think if you haven't realized this yet by this time point, then I don't know what you're doing. If you're not listening, you have to take notes. If you're still losing and if you're still not profitable, that's probably why, because you're pushing too hard in low probability conditions. And I'm seeing that this video is already 17 minutes, so I wanted to quickly again give a shout out on my Discord. If you're interested, you can join through the link in the description. I always post my links to the videos, and in the future we will get exclusive insights to my analysis right in the Discord. We're currently relaunching it, so yeah, feel free to join in the link in the description down below this video, and also check out my X channel. Also will be linked in the description below. Again, I thought I would start a journal entry with some short and nice precise trading advice. So journal from yesterday's journal entry. Again, do not buy new challenges, because this will not erase your trading mistakes. You have to work through them. Don't fall for the illusion that by buying a new challenge, you will just have a smooth equity curve and everything will be fine. No, you have to work on the things that you did wrong on the previous accounts, which have led to the point where you have blown the account, and focus on not losing the account. Do not focus on passing, because if you reflect, probably 90% of you traders blow your funded accounts or challenges, whatever you're doing, CFD futures, you blow them in 1 or 2 weeks. It's not the problem that you're blowing them in, like, I don't know, 1-2 months. No, you're blowing them in 1 or 2 weeks. Usually, if you reflect and go back and look at your trades, at your challenges, you blow them in 1 or 2 weeks, because that's what I was doing. And I know that many people also struggle with this. And this gives you feedback. It gives you feedback that you are over leveraging and that you're risking too much. And if you haven't had success so far and you've been blowing challenges and not getting any consistent payouts, then you have to work on this. And your focus should be then to not blow the account, make it impossible, risk as little as possible. So it's impossible to blow this account in 1 or 2 weeks. Like, try to fail this account in 1 month. It shouldn't take you less than 1 month to fail this account. Because if you blow it in 1 or 2 weeks, like, what are you doing? Are you gambling? Because you're over leveraging, that's for sure. You're over trading, that's for sure. So yeah, again, view this game on the long run, and then feel free to subscribe to this YouTube channel. I hope you found this video insightful. I hope you could use my market insights and my new protocol for equity trading. Then give this video a thumbs up. As you can see and hear, I'm already tired and I will go to sleep after this video is uploaded. And then we will see us tomorrow for CPI, and I wish you all a pleasant evening and a good night of sleep, and we will see us tomorrow. Stay safe, trade safe. Bye bye.